Hi, everyone, and welcome to today's webinar, 2022 M&A Results and Valuation Statistics. Just want to start with a few administrative details before we begin. If you experience any issues with today's webinar, please contact Irving Levin's customer service at 203-846-6800 or email us at info@levinassociates.com. If you have any questions throughout the call for the panelists today, you can enter them in the Q&A box at the bottom, and we'll do our best to address them throughout the hour. And if we don't get to some of the questions by the end of the hour, then we will do our best to follow up via email. Attendees can find a copy of our slides in the chat box, but please contact our customer service team if you have any issues with downloading them. They'll be happy to provide you a copy. And lastly, a survey will appear at the end of today's webinar. And as always, your feedback is greatly appreciated. We help we use it to help improve our future broadcasts. And also, we'd love to hear about any suggestions for future topics to help inform this year's webinar calendar and next year's. So please be sure to fill that out at the end. And without further ado, let's get to know our panelists today. And I think everyone will see that we have a very well-rounded panel. So first, we have Alex Floria, who's a managing director and the head of capital markets at Blueprint Healthcare Real Estate Advisors, where he leads the firm's capital placement and capitalization advisory services. But he also still works on the investment sales side as well. And prior to joining Blueprint, Alex was the manager of corporate finance and strategy at Care Capital Properties and Sabre Healthcare REIT. So good to have you on, Alex.
Great to be here. Thanks for having me.
And next we have Camilo Padrone. He's the Senior Vice President of Investments of Lloyd Jones's Senior Living Division, which has been one of the more active acquirers within seniors housing in the last couple of years. Does it correspond with Camilo joining in 2021? Perhaps, because he and his team have closed on 9 new seniors housing properties since then, and that number will be growing. But he also has development and capital markets experience from his previous roles. Welcome, Camilo.
Thank you for having me.
Glad to have you on. And finally, we have David Young, who's the managing director of structuring at Locust Point Capital, a direct lender to the lower middle market seniors housing and care industry, where David is responsible for overseeing the financial analysis and structuring of portfolio investments. But he served in roles in both the operating and investment sides of transactions, participating in over 70 deals, totaling about $1 billion in his career. So David, just be sure of what hat that you wear when you're answering these questions, operator or from the investment side, but good to have you on.
Thanks, Ben. You got it.
And we have a lot to cover today, starting with the overview of our 2022 M&A and valuation statistics, which we've derived from a combination of publicly available information and deals and details that are also confidentially disclosed to us for the purposes of calculating these statistics. Those statistics that we're going to go over in the webinar, plus many others, are included in our Senior Care Acquisition Report, which will be published next month, and in the analytics page of our Levin Pro LTC platform, where users have the ability to toggle between our public data and our proprietary data when looking at those graphs. So just want to say that if anyone is on this call and helped with those data collection efforts of ours, just want to say thank you, and these are the results. So we'll start with the basics. As you can see with our first graph, we had a record year last year just in terms of M&A activity, with 539 publicly announced deals, by far record. And Alex, I'll throw to you. Why was that?
I think honestly, a lot of that was probably carryover from end of 2021. I think if you think about kind of how that year progressed, you have the broader rollout of vaccines. In the early part of the year, you have adoption growing. And as you get into the second part of the year, what you kind of see is, strong, and at the time, very data-driven optimism about operating fundamentals, right? Like, we're really seeing up, COVID is more, not gone, but more manageable. Mm-hmm. And you still had, basically, not literally, but basically zero interest rates. So if you're excited about the operating fundamentals, if capital is very, very cheap, it makes a lot of sense to transact. It makes a lot of sense to kind of work through your growth appetites, your monetization mandates, if you've been holding for a while that you just couldn't through COVID.
Mhm.
So I think a lot of inventory, a lot of product came to market in the second half of 2021, in the first half of 22. And I'm sure you'll touch on this later, but 2022 wasn't exactly evenly divided in terms of closings. So I think a lot of it's momentum and the realities of, even when things are going well, like, selling a senior living or SNF building is not a 3-month process.
Mhm. Well, actually, if we go to the next slide, we'll see just how the momentum really slowed down towards the end of the year. It didn't slow to a complete stop, as we could see compared to early 2021 activity. Although early 2021, vaccines were still getting rolled out, very different market. But we can see that throughout 2022, deal activity was kind of consistently, or not consistently, but somewhat averaging around 50 deals per month, and then that dropped to the high 30s in the last several months of the year. My guess is that this trend will probably continue throughout most of 2023, but Camilla, what are your thoughts on that?
Yeah, I think it all depends kind of where capital markets are kind of heading and what that direction looks like. For us, we are seeing quite a few deals that kind of, Alex mentioned, that rolled over from last year, kind of still trying to find that sweet spot, or maybe fell out due to some financing getting more expensive. But I think everybody's pretty optimistic, and the people that need to sell have to sell at this point, maybe.
Mhm.
So we do see kind of activity kind of trailing the higher direction, probably Q2, Q3. But I don't see that 63 deals in January happening any month this year. But who knows?
And just regarding that number, I have to say that this graph is only referring to deals that were publicly announced. So either through a press release or sent via email to us with the, I guess, ability for us to publish that. In December of 2021, that number was even higher when you factor in a lot of deals that closed behind the scenes. That's generally true for most of the year as well, with deals that are privately disclosed to us, but just have to note that. And the next graph as well has to do with publicly announced dollar value of transactions. So David, I want to get your view on this. 2021, to us, it seemed like it was the year of the big deal, a lot of major dispositions, a lot of companies that were making serious purchases that were, quote, below replacement value. And so 2021, we saw dollar volume really pop. 2022, even though we had a significant number of more transactions, the dollar value was lower, and it seemed to fit the theme that we saw throughout the year, that it was more the year of the one or two property transactions. Would you agree?
Yeah. So 2021, I mean, probably honestly was a little bit of mean reversion if you look at 2020, just the idea of coming back from stuff that was pent up, the uncertainty due to COVID, the pandemic, and how we're going to look at, going forward. That said, 2022, I suspect a lot of that right there was skilled. I doubt many folks were that prescient where the forward curve would be now versus say 12 months ago. If you think of the evolution of the forward curve and people's expectation of, where does SOFR go, and then that evolving to higher for longer, right?
Mhm.
Concerns. So I think some of that's in play. That's probably off the cuff how I'd react to the last 3 years, I'd say, based on that.
Yeah, I think I'd agree. If we go to the next slide, we're going to start to get into where values were in the last 10 years. And interestingly, for seniors housing properties, which we have included assisted living, memory care, and independent living, and this is these stats are derived from a combination of the publicly available data and the prices, financials that are privately disclosed to us. We see that the average price for seniors housing properties overall rose to $211,800 per unit in 2022. A little interesting, we can see that the median price is far lower. So just the average community that sold was for a lesser value, but we can see that some higher price portfolios may have swayed that average to a higher level. I think my interpretation of this graph, though, is that we just have not seen a huge wave of distressed deals hit the market yet or close. And that stabilized properties are still selling at strong values. So we have that combination of, we've got those higher priced portfolio deals at the top of the market that's helped skewing the average up. And then we have not seen a huge amount of those kind of bottom sales of really struggling properties, or properties that are even just like, not doing terribly, but not really performing that well. We haven't seen that wave of properties hit the market. Alex, what do you think?
I mean, I think you got to be a little bit careful with that, because this also doesn't really include vintage asset quality.
Mhm.
I think a lot of the, let's say, value add, room to love communities that are going to trade this year, they'll be above 200 a unit,
Mhm.
because they're in major metros and they probably cost 300 plus to build. I think a little bit of a challenge with this is kind of the composition, where you're really looking at the trend line more than the absolute number. I also the fact that it's based on what's publicly reported, you're going to have some of those bigger, chunkier deals that are going to generally be at the top of the market and are more likely to kind of sway it.
Mhm.
So I don't know that necessarily seeing more of the value add is gonna necessarily move the average up and down. It really depends on what the composition is.
Mhm. Yes, that's a good point. I mean, clearly the average is a composition of the properties that just sold that year. So it's totally dependent. If you have a year that is just dominated by struggling community sales, then the average is going to be much lower. Even if the market for stabilized, high quality properties is still going quite strong. Let's actually skip ahead a couple of graphs. And if we skip a couple of these statistics, just our viewers can access the slides later on. So let's go to, we break out the average price per unit for, let's go back one. So we break out the average price per unit by seniors housing property age. And we can see that for the newest communities built in the last 5 years, the average price paid per unit actually went up compared to the previous year. And then as we can see, the oldest communities actually went up in value as well. There's a lot of factors that are potentially behind this. But Camilla, what are your initial thoughts on this?
I think Alex touched on it a little bit. It's kind of what composes of those, type of builds. Are they the distressed assets that, are in that end of lease up phase, or the old construction stuff that, really need that heavy value add in it. So you're always factoring that into your purchase price. If something's being offered at 200, but you really got to put, 30, 40 grand into it, your basis is higher. So I think on the newer stuff, what we've seen lately is kind of a little bit of a discount to replacement, given, the upside potential and that lease up potential. On the older stuff, we've seen stuff at, 20, 35,000 a door, all the way to, 150, 190, just depending on the market and where they're at. And I think it gets to a point where it's more market driven versus, comparing, hey, something sold here versus something sold there, and kind of what that opportunity is for upside.
Mm-hmm. And let's head to the next slide, which has to do with the average price per unit for independent living properties last year. We can see that it rose pretty significantly. One thing to note is that this sector, compared to assisted living, is a much smaller market size. So there's far fewer independent living properties that are transacted throughout the year. And so the sector is a little more prone to bigger swings in its average price. And we do have to say that there was a major portfolio deal that closed during the year that was off the record, that had a high per unit price that definitely skewed the average a good amount. When taking that deal out, just for curiosity's sake, the average still rose to around 230,000 a unit. So a pretty big bump. I don't think we have to rest long on this slide. It's such a small market. Independent living, clearly the more, I think, sound of a sector coming out of the pandemic, less staffing needs, its occupancy held up better, it's got a younger clientele. I think what remains to be seen is the impact of active adult on independent living values going forward. And active adult will be a sector that will include a new section on within our acquisition report next month, bringing out some new statistics. But let's head to the next slide and switch to the skilled nursing market, which I think it was pretty much a consensus that skilled nursing facilities, the market for them last year was probably at an all-time high. Buyer interest was at an all-time high, and facilities of all qualities sold for generally higher prices. And we can see that the average for 2022 was $114,000 a bed. David, what are your thoughts on this? Is this kind of what you were seeing just as far as how skilled nursing facilities were valued last year compared to previous years?
Skilled nursing has gotten a lot of support through the pandemic. They had in a variety of ways, right? Whether it's the cuts to sequestration, temporary bumps, Medicaid, right? The 3-day stay waiver, all that. And some of that's tiered off at various times, the ERTC funds, right? The payroll funds. So all that basically points to a really good position for skilled nursing operators from a solvency perspective. If you're just looking at balance sheets, skilled nursing is still the one asset class that has pretty decent positive leverage. If you look at SOFR right now and you apply a sane margin or spread for a senior secured loan, right? And it also has a good exit for HUD, right? So given that, I think that skilled has been a pretty frothy environment, depending on what state you're looking at. Obviously, there's trips and traps around the risks associated with individual states, minimum staffing mandates, whether it's a federal level or state-based, right? But yes, it's funny, the stair step from 2020 to 21 and 22 has occurred. I think it's probably that price will probably flatten out on average. I don't see it continuing to go up at that rate of change, but could be wrong on that.
Alex, what are your thoughts?
I mean, I think in part it's like skilled is such an interesting space, I think, because of the impact of HUD. Like there's really nothing else where you have the availability and the just broad market acceptance of that leverage point. There's a lot of people in senior housing that wouldn't go to 80 even if they could. I think that gives it kind of a level of support that you don't really see anywhere else, especially with how low those rates are. So I think David kind of like really hit on something where the spread that you can generate there is really kind of unmatched. And as you think about multifamily, seniors, some of the other things that you could invest in, you have negative leverage on those. I think that the sort of returns that you can make are, at least in the near term, from a theoretical mathematical standpoint, underwater sniff, your margin used to be this and now it's this. Okay, you've gotten cut down, but you're still talking about positive spread. So I think that's helped. I'd also say part of it is, those deals probably still take 6+ months to do. I think that the one thing that would be kind of interesting is when you're looking at these, this is when it closed. Shift everything back half a year. Really more the decision is, what were you thinking when you launched the deal versus when you closed the deal? You may have lender delays, you may have licensing delays. I think that's kind of the interesting part as you see it. And yes, I do think skilled was kind of a beneficiary of some of the COVID byproduct policies and kind of changes in market dynamics more than other property segments.
Yeah, to pile on, if I can, it's funny, you can actually see certain states, the distribution of states, least favorable, most favorable, arguably it's widened, right? Certain states like Rhode Island have pretty onerous minimum staffing efforts when half the SNFs in Rhode Island are rural. I mean, it's not a majority of Rhode Island rural. Good luck finding those CNAs, right? But then you look at states like Florida and other states where you actually have somewhat of a deregulation where they'll allow hours from maybe, in order to meet certain staffing metrics, certain staff can fill those hours, for instance. And they've enacted Medicaid bumps as well along the way that are legislated through. So you're now seeing Medicaid be a better payer than one would have fathomed in 2019 and before.
Yeah, I would say that few probably would have predicted how, I think, strongly the SNF market would have come out of the pandemic. And obviously buyers are recognizing that. Alex, I just wanted to touch on kind of your point of where buyers initially saw kind of values when they were looking at deals a number of months ago, and then what versus what they eventually paid. And we broke out the SNF deals for 2022 by the first 8 months of the year and by the last 4 months of the year. And that's kind of like a rough point of when the market mood really shifted, when rates rose above a certain level. And the average price paid for per bed for SNFs dropped by 20%, comparing those two periods, which was kind of similar to the level that we saw, like we were consistently hearing that compared to the spring and summer peaks. So I just wanted to mention that.
Yeah. I mean, that's one part of it. I think the other part of it, honestly, is, and maybe from a broker standpoint, I'm also just as focused on the seller's mindset.
Mhm.
For somebody to, for us to take it out and for somebody to bid on it and me to bug David for some non-recourse, the seller has to agree to sell it first. And I think the state of the market and kind of the nature of that conversation is just as indicative.
Yeah.
If you end up with a closing months later when the market could have shifted, a country could have gotten invaded, performance could have shifted all these things could have happened.
Mhm.
And sometimes the outcome isn't necessarily a good indicator of, okay, well, when you decided this is the right time to sell, we should sell instead of recapping or refinancing. What was the decision-making process?
Mhm.
And I think
I can't let that go though, Alex. Non-recourse on a SNF. Next thing you're gonna ask.
it's in general. It's in general. It's in general.
My committee would have my head if I didn't let that go. Right, didn't let that go. Sorry.
You knew what this webinar was going to be. It's not the last of those comments you're going to get.
Claws are out. I love it. Well, Alex, this actually takes us to the next portion of the webinar, and I just want to skip through the last several of the stats, which are we break out the skilled nursing market by stabilized and non-stabilized facilities, which we have defined as stabilized being 85% occupancy or above, and non-stabilized being below that level. It's a very rough definition for what stabilized is, and the definition is definitely changing in the last few years. But this is the difference in valuation purely based on what trailing occupancy was like. And then the last several stats are on the cap rates for the skilled nursing, independent living, and assisted living sectors. Our viewers can kind of view them in the chat if you want to download the slides, and if you have any questions on these, feel free to reach out. But Alex, I want to shift to kind of talking about what changed in the market last year, and you brought up the seller's mindset. So what changed in the seller's mindset at some point last year, based on what you saw?
Yeah, so I mean, I don't know if changed is necessarily. So it's an interesting framing, right? I think some of this reminds me a little bit of COVID, where as you looked at the shift in interest rates, it's really hard to gauge what it is at first. Is it a blip and it'll go away? Is it the end of the world? Is it kind of somewhere in the middle? And I think some of the challenge there was just the inability to really tell. How bad is it going to get? How long is it going to last? What is this? Should I just sit out for 3 months? Is this going to go away and I should buy the dip? I think towards the end of the year, what you kind of got to was a little bit more of we started having more grounded conversations with folks where it's okay, look, higher interest rates are here to stay through the medium term. I don't know where you'll be in 3 years, but if you're asking, do I think they'll go down next year? No, I don't.
By next year, do you mean in this time next year in 2024?
Yeah.
Mm-hmm.
And I think what it kind of turns into is, okay, let's say that cap rates have, we'll argue how much, but they've definitely gone up, and that's driven by interest rates being materially higher. Mm-hmm. To some extent, it's purely mechanical. Based on that reality, at least for the next 12 to 18 months, let's talk about it and let's see what makes sense. So I think what's changed is as you're having that conversation and it's more grounded, it's easier for people to kind of look at it and go, okay, what are my options? Let's talk through all of them. If I have the liquidity and the conviction, okay, I can stay the course. If I'm missing one of those two, let's talk about how to explore different options. If I'm missing both of those two, I don't like the price, but if this is what it's going to be through the end of my horizon, would you rather go early or go late?
Mhm.
So I think it turned into a much more kind of tactical conversation, and it was easier to talk about, like, okay, with a set of stipulated facts, what are we going to do? And it was easier to kind of move off I think that the biggest challenge was moving off of the, well, end of 2020, this would have been worth X. Yes, I don't disagree. It's weird to talk about the world's different, 6 months later, but it is.
Mm.
And I think once we kind of moved past that discussion, it was easier to talk about, okay, what do you do now?
Mm-hmm. And flipping to the buyer's mindset, Camilo, you were involved in a number of acquisitions last year. How did Lloyd Jones's approach change as a result of the capital market shift last year?
Yeah, so I think we had, like Alex said, we kind of had two different markets last year. I think the first half of the year, you saw, a lot of aggression towards deals, just people paying, higher dollar amounts, people being more active, and a lot more trades from that. And then we got this first wave of higher interest rates, and everyone's like, okay, let's kind of see where things are. And then it just kept getting a little worse, and you saw things slow down a little bit. For us, most of our momentum last year was in that Q1, Q2, and kind of end of Q3, and we had some straggling deals that closed in Q4. So we were taking advantage of those low interest rates, trying to, make sure we can get those deals under wrap before things got a little crazy. And I think this year, our strategy pretty much stays the same. We're going to be more cautious from a price per unit, barrier to entry type thing from the market standpoint. But, we're still looking at, heavy distress stuff, the light value add or the redevelopment buckets as well. We have our full construction team, and we've taken on those type of deals, stuff where you're buying, almost vacant buildings, putting in, insane amount of capex and basically bringing a new building out of the ground. And so us, we like that strategy. And I think the more of the core A stabilized stuff probably doesn't make sense for us this year, just given where prices are at and kind of where sellers probably need to be at. And Alex, you can correct me if I'm wrong, but sure, if you're all in at, call it 400 or for something, I don't think the heavy discount is coming yet, and maybe I'm wrong. So I think we're still going to be playing in that box of that value add strategy, and we see a lot of opportunities coming. We've seen a lot of it already this year. We have a few deals that we're trying to get under contract now, and that sellers have to sell. So I think we'll continue to see that throughout the year.
Do you expect to have the same number of transactions or more compared to last year, or less?
Well, if I say anything less than last year, I think Chris will kick me off this webinar. So I will see, our goals this year are pretty ambitious. We want to at least get 20, 25 deals done from a buyer's perspective. Mm-hmm. We also really want to get into the third-party management business. And I think we're just trying to get creative like everybody else is from a structuring standpoint. What does it take to get a deal done today? Is it seller holding back a piece? Is it getting, lower leverage financing, or, paying David the 12% money that I know he can give me for a deal that's negative cash flow? So I think it just depends. We do like this strategy of kind of third-party management, and then kind of figuring out a structure later if the seller really doesn't want to keep current management in, kind of doing a manage the purchase option type thing. So I think it's just kind of where things are at. Every property and every situation is different, which is, I think, is unique to us in our situation. So, but that's kind of where things are for us.
And David, what changed in the lender's mindset, and also, I guess, how did your approach at Locust change at some point last year?
Well, so it's funny, Locust Point's primary strategy, we've always had a primary strategy of owner operators skin in the game. The operators get skin in the game, and they have upside, whether it's through a promote or they own it completely. So that hasn't changed, but what has changed is how we execute around that, right? So what you've seen, particularly if you call October the catalyst at some point when things kind of the capital markets became more disjointed, we're seeing less new construction, right? Fewer new construction deals right now, simply because the equity IRRs don't pencil, right? Those who are lending new construction are doing so at 55% loan to cost. Non-recourse new construction's is off the table, things like that. You're seeing also more heavy value add. And by heavy value add, simply put, call it a deal that's zero. So it's C of O now to 2 years old. It's at the construction loan maturity, or it's into its first, if not second extension, and they're facing a remargining, and place debt yields are 5. That would have been a 1.0 cover a year ago, 1.1 maybe, if it was a tranche deal. And now it's like a 0.5 cover, right? And so that's more of a transitional deal from a pure cash flow perspective, just given SOFR's rise from the grave. And then we're also seeing currently more SNF over senior, simply because, as Alex had mentioned before, positive leverage versus negative leverage, right? So that's just a function of how the pipeline has kind of changed or morphed over time, for what it's worth.
Mm-hmm. And were there any other, I guess, factors that that in 2022 affected deal making, I guess negatively affected deal making? The first thing that comes to mind for me is just property insurance costs rising to a certain point that made buyers or lenders reconsider deals. And anything along those lines? I'll throw that question to everyone.
Happened to us in Florida. I think, after the storm came, we saw premiums kind of skyrocket a little bit. They've come down since, but they're still very challenging. And, you got to pay $50,000, $75,000 more in insurance. That affects price. So I know when I call Alex and tell him, hey, I can't get to this number, and tell him why, it's a hard story for him to sell, I'm sure.
Alex, what do you think?
I think Camille is just making excuses. That doesn't sound right to me. Look, I think one of the other challenges that's not a secret is, I would say I'm generally seeing labor get better, not as quickly as people would have hoped. And I think it's more market specific. It's one of those, is there improvement? Yes. Is it what you thought it was going to be? No. So I think that's been something that I think people are trying to be thoughtful and realistic about. And I also think just on the capital market side, it's also harder to get non-recourse. I think all of the uncertainty, the pressure on coverage has made that segment of the market kind of a lot tighter, which I think for some buyer profiles is really challenging. I think there are a lot of folks that have said, I'd take 45, this is senior housing specific, but I'd take 45, 50% leverage on this, but it's got to be non-recourse. There were times when that was very tough to find for something with negative NOI. Now that does exist. It's gotten done on actually a couple of our deals, but I think that's one place in the market where you have to work a lot harder to find it. And that I think was more of a just kind of macro and psychological barrier for some of the folks chasing seniors deals.
Where can you find that?
So, I think it's either, if the sponsor and the story are right, I think I will keep going back to David. I'm going to try not to make it just him, but I do think, honestly, that's one of the roles that I think the debt funds serve, right? They're there in a place where they can go, okay, the 1.0 isn't a magic number. I can price risk. Convince me that the story is real. Convince me that this is a real deal and we can do it. I would also say that if you're thinking about kind of the bank market, it's local, regional folks. And it's a variation of that. Hey, this is somebody who's in our market. This is an asset that's tangible. We get the story. We like it. You're going to be potentially pleasantly surprised. It's going to be a batting average exercise. So if you're trying to find the right local bank, like you're not making 2 or 3 calls, you're making a lot more than that. Mm-hmm. So I think that's where I've kind of seen success. The national and super regional folks, really not as much.
Yeah, to Alex's point, it's more like a participated or structured transaction where it may be led by a debt fund, but behind the scenes there could be a depository. And so you're able to blend down that cost of capital. So you don't have to pay mezz money on the whole deal. You rather pay a hybrid of, senior and mezz money. And then it just simply comes down to splits.
David, are you guys doing anything different from a reserve kind of outlook on stuff? Are you guys kind of saying, hey, we need the max now versus kind of getting by with maybe a lower number? And is that affecting, people's deal cost from a standpoint that, hey, we can't bring in this extra $500,000 of reserves, so we got to back out? Have you seen any of that yet?
As far as like project level reserves being sufficient?
Yeah.
Look, we look to the project to support itself. At the same time, we look to the guarantors for the global cash flow or the sponsors for the global cash flow. So obviously everything's different, but if someone can substantiate, they have good global cash flow, their liabilities are non-recourse in nature with no maturities looming on the horizon, substantiated by a decently scrubbed REO, that goes a long way from saying, hey, I've got the cash flow I've got this really good deal, bird in hand. I don't have the immediate equity to fund the lion's share of the reserves, but I've got global cash flow, and I'd like to not dilute myself down by bringing in an LP who would fund that reserve ticket. So we would look to either potentially refunding the reserves depending on the basis, or simply looking to the continued global cash flow to support the community, depending on the nature of why the deal needs reserves in the first place. So for what it's worth, yeah, all those different, iterations.
And Alex, I just want to quickly touch on bid-ask spreads and just where they currently sit for different types of deals, because I know that has been a major hurdle since the pandemic of getting deals done. So are you seeing bid-ask spreads narrowing, and for which property groups, if so?
Yeah. So, as a general comment, I would say yes. And I think some of that is just expectation setting and education.
Yeah.
There's a lot of folks that are in the market as both buyers, sellers. They're, talking to JV partners. There's just enough data points where I think everybody's expectations are kind of starting to coalesce. I think that helps a lot once you're through kind of most of the shock versus, while you're going through it. Mm-hmm. I would say that a couple of things that kind of affect that is, part of it is the liquidity of the product type and the market type, right? So if you have high quality real estate in a major metro, it's a deeper buyer pool. There's more trades, so people have more data that they can leverage to kind of set expectations. There's more data, so it's easier to kind of track throughout the course of the year how prices are trending. It's easier from a seller and broker standpoint to drive pricing if there's a bunch of folks that are interested. So I'd say as you think about those more liquid asset or market types, the spread is narrower just because there's a lot more data to work with. And if everybody's doing their job right, we should all come into it with relatively reasonable expectations. The stuff that's more thinly traded, or you go, oh, I don't think I've seen, this deal profile in a while. Hey, I'm going to go to what Ben publishes, publicly. There's really not a great comp in here. I think I can interpolate what the right answer should be, but it's harder to really support it with data. I think those are kind of tougher. The other thing that I would say, I'm trying to keep this kind of universal across all product and asset types, because I think it is just kind of conceptual. So the bid ask is narrower, I think, on stabilized assets because it's really just math. You have more options to finance. It's easier to get fixed rate if you have a stable deal. If you're talking about seniors, you could do Fannie, Freddie, HUD Life Company. So I think it really just gets into what's your holding period? What's the growth? You can really just work through it on arithmetic. I think where it's still potentially wider are some of those early lease up value add deals where you have, I guess, different dimensions of risk, right? So what is the timing of lease up? What is the timing of staffing stabilization? What is, there's a range of what's your carry cost going to be? What are interest rates? What What might you have to bring for reserves? What's the exit cap? And I think those can be trickier because it's not, you can force it down into arithmetic, but I think it's just as much psychology. I think that's the one where different people will just look at it differently. And that's what creates some of the bid ask. I mean, I think the flip side of that is I also think that's where you're going to see some pretty strong interest this year. Yes, there's going to be a lot of supply that's more value, like it's more value add, but I think for people that are long-term investors in the space and are well capitalized, I mean, this is a great opportunity to pick up some value add product in that's new, nice. It's in gateway markets. I mean, we're looking at stuff in the Philly MSA, around DC, nothing quite in Miami for Camillo, but something that hopefully is close enough. There's some of these that, you know, you've got a sponsor that's looking at it and saying, I don't see myself being in this for 2 to 3 more years. It makes sense to exit now. But if you're coming into it, you're a 5-7 year hold. The basis you're getting versus replacement cost is outstanding.
Yep.
7 years from now, it will not be cheaper to build in Philly. I'm just going to say that right now. But look, I think Camillo's point is a great one. I think you also have to be realistic about this, where it's not just a price I quote you, right? It's deal costs, it's your financing costs, it's all of your carry costs. So I think some of that, like, it ask spread is also, let's make sure that we're all quoting it thoughtfully and intellectually honestly. Because I think that some of those deals can create the gap where it's like, okay, this is, you know, 275 and that's below replacement cost, 75 all in, or 275 to you and then 50 on top. But there's going to be some very interesting stuff there. And I think that's where, if you have the liquidity and if you have the time horizon, you can make a killing on some of these.
That actually takes me to my next question, which is for David. What's an easier deal to finance right now? Is it one of those turnaround acquisitions, or is it a new development project?
The equity would say turnaround acquisition because they like the basis. The senior lender would say development because covenants don't start till 2027. So they're outside that negative leverage peak of the forward curve, right? And we as a sub debt lender would say neither. So I think it really depends on where you're at on the table. I think right now, if you can go in, like Alex said, table poundingly, if you can go in on some seniors housing stuff right now, you're going to have the best returns you've probably ever made, assuming you've been investing for, you know, a decade, you know, post GFC. So I think it all depends on, you know, easier deal to finance. It's all the blocking and tackling, right? Does the operator have skin in the game? How much alignment of interest does the operator have? What's the basis, right? Because you really protect yourself and kind of set your floor from a loss perspective based on basis. And then the one good thing is there's not a lot of new development right now. So some markets, new development actually does make sense, provided the equity is comfortable with having those lower returns due to simply just increased costs, increased carrying costs. So from a turnaround acquisition perspective, oftentimes you get in this vicious cycle of, okay, you know, you have a lower purchase price because your debt costs are higher, which creates an even lower purchase price. And so you get in this iterative cycle where the basis may be really good, but the cost to finance the deal, the more heavy the turnaround, the more difficult to finance, but the greater the upside. Therefore, the more higher the cost of capital, therefore the even more difficult to finance, but therefore even the greater the upside. So you get in this funky like Excel rough out where it just continues to circle. And at some point you have to say, I like it, execute, and hold your nose for the cost of capital that you may have to bear, keeping in mind that it's a money good deal.
And Camilla, you've executed on some of those turnaround value add deals. How have you been approaching financing those kind of deals in the last, let's say, 6 months?
Yeah, I think lately, if you're, like Alex mentioned, your handful of lenders that you were looking at last year are probably a little smaller now. So you have your debt funds. And then I think what we've noticed is those smaller local banks, are really getting aggressive and trying to get deals done. It's surprising to us, and maybe it's a sliver of recourse with a burn off, after certain hurdles. But I think it's just, when we look at a deal, you got your price per unit, you got your price per capex, your reserve, and then it's just kind of putting it all together and seeing if it makes sense. And I think, like Alex mentioned, it's not just a 3-year hold, it's not just a 5-year hold, maybe it's a 7-year hold. And if we can weather the storm for that time, then our exit on the upside is going to be there. And like David mentioned, it's, are we in it or are we out of it? And it's just, we're going to go through it, let's do it, and let's pick the right partner to make sure that they'll work with us and understand the environment that we're in. And I think from an equity perspective, everybody's return metrics that they're looking for, I think they have shifted since last year. I think people understand cash yields are going to be a lot lower now, just given where interest rates are. So you are more IRR focused on certain stuff. But I think, everybody still has that same mindset. And I think for our company perspective, it's not a 3-year play, it's a 10-year, 15-year plan for us. And as we grow into that, aging demographic, the no supply coming online, we do believe there is, that light of the tunnel for us, and our investors that do partner with us, are on that same track with us.
Good to hear about all those local and regional banks. I guess we'll wait and see whether the nationals will kind of come back a little sooner than maybe they would. Maybe some people are thinking. Amazingly, we have about just 15 minutes left, and I still want to get to our last couple of sections. Anything else to add just on the financing environment, Alex, David?
I think we've kind of beaten it to death. I think what the math is. Come prepared, come ready to have an intelligent, thoughtful conversation about how to make it work, how to manage higher interest rates, how to manage some of that variability, and be ready to have, I think, a conversation on structure where maybe, David's not going to get everything that he wants, but you're also unlikely to be able to get away with giving nothing. So I think let's talk about what are the options, what's there, how do you structure something that makes sense, right? Everybody looks at it and goes, okay, yeah, I get it. I get why you do that.
Mm-hmm. Well, let's move on to just how to get deals done these days. And David, let's start with you. What are you looking for in a potential transaction right now?
Perfection.
You heard it here.
Yeah, right. I know. I think right now there's a lot of opportunity around. So for skilled nursing, it's depending on it's state dependent, it's operator dependent, and can you comp out their projections, the infamous day one projections, right, to their REO and how they've done it before, and do they have a good clinical back office and all that. That's one component around surrounding SNFs. Within seniors housing, we see more of the value add upside in seniors housing. So focusing on seniors housing, what we look for in a transaction is simply the alignment of interest and skin of the game. Can't pound that enough, honestly. From the operator perspective, does the operator have an incentive to perform on this deal? If not, generally speaking, for us, it's a pass. Some folks do perfectly fine with third-party manager, and that's their investment strategy. Oftentimes, our primary strategy is more that owner-operator or JV, where at least the operator has a promoted interest in order to really knock it out of the park, assuming the promotes are set at sane margins, occupancies, NOI thresholds. Beyond that, though, as far as structuring, it's also, if you like the deal, it's one thing. But if it can't stomach the cost of capital, then, and you can't structure it to blend down your cost of capital, then honestly, you're dead on arrival, even if you like the deal, because you can't make the deal work. So that oftentimes is what also keeps us in the senior space from moving a deal through the pipeline, for instance, just those exogenous factors that are completely outside of your own purview, driven by pretty much just SOFR and banks who have had deposit flight as deposits have fled to short-term treasuries and other higher yielding assets. Banks have had lower refinancings. And so now you're actually seeing all equity deals on some value add acquisitions. You're actually seeing equity finance deals. So it's almost completely unlevered. It's very interesting.
Wow. Alex, I'm going to ask a similar question to you. What are you looking for from a potential client? And I'm also going to throw to you an audience question. How are the smaller local banks handling recourse?
So let's do the local bank question. As a general rule of thumb, I will say those folks are recourse lenders.
Mhm.
Like they're used to working with people like a warm body, somebody who's known the community, somebody who's an owner, operator, developer. And the terms can be standing, but they're going to be looking for some level of recourse, and they're going to, generally speaking, not be amenable to the, well, my fund mandate forbids fund level recourse. That said, there's definitely some outliers in that. And I think that's a place that you can kind of get lucky. It's also, right, like if you think about how many national banks are there versus how many regionals, one pool is deeper, right? So your hit rate's going to be lower, but I think that's a place that you can get lucky. I would say by and large, if you're going to go the local bank route, you're potentially going to get some really outstanding terms, but you should, in all likelihood, plan on some level of recourse. It may have burn downs, or they may be honestly more flexible. But I think it's more of a cultural thing as a general comment. I think it's something you should be exploring anyway. It's a place that we've been very surprised, and we've seen people get surprised with some good non-recourse offerings. That is not the most likely outcome. So I think for whoever asked that question, it's not a get out of jail free card. It's just they're more competitive than they would have been before. And I think it's something you really have to look at, just because you'll have fewer options overall. I think, to the question of what am I looking for in a client?
Other than perfection.
So I was going to make a joke. I don't think I was going to go there. High fees, low expectations, hug after a tough week. Broken feelings too. We're like not quite a person, but we're fairly close. Okay, sorry. You said that, I was like, oh my God. We get through the bank answer so I can. Honestly, I think the thing is just honesty, transparency, candor. I think right now it's still kind of a disjointed market. There's still a lot to work through. I think there's a lot that we can bring. And I think that, sell blueprint a little bit. Like I saw in some industry publication, I don't remember where, something about like where did close to 2 billion to seniors. There's a lot of tools. There's a lot of resources we have. There's a lot that we can do. I think everything now is honestly more granular and more work intensive, but we can help answer whatever question you have. We can help you work through whatever dilemma you have and arm you to make the right decision. You've got to be realistic. You've got to be transparent. You got to give me something to work with so I can actually help you do that. I think that's the biggest thing that we're looking for, where it's like, is this going to be a real conversation? Can we skip some of the gamesmanship? Can we move past some of the, okay, if I keep saying this, if I repeat this to you often enough, will you start to believe it? And just be like, let's talk about it. Help me help you. What do you have? What do you want? What do you need? What do you need? Which is different than what you want. Like, help us kind of set the board, and we can help you game plan and execute to the best of our and your ability. Tell me what's up.
And Camilla, what are you looking for when you're evaluating an acquisition opportunity?
I think right now it's full transparency, where things are at. The story on the deal for us is very important, and it's probably just as important to everybody here on the call. It's, what happened? If it's a negative cash flowing deal, how did it get there? What caused it? Was it an operator change? Was it something in the market? Just getting for us a better understanding of that story, from pricing and kind of where we come in at stuff, being, on an open communication with Alex or whatever broker we're dealing with, and just saying, hey, this is where we're at, this is why, and then, seeing where debt comes in. And like David mentioned, a few minutes ago, it's, can the deal stomach the debt where we're at? So there's a lot of deals that we love and we're like, well, it's a great market, hits the, all the check marks that we have. And then we start, sizing the debt and it's like, it doesn't look as good now based on what we heard today. And then tomorrow there's a rate increase and it's like, oh, it doesn't look as even good now. So it's, it's things like that that we just try to be cautious with. But for us, it's, making sure we understand the story, understanding the market, given the potential upside and the value add. What does it need? What's the overkill value add? Sometimes we look at a property and it's like, does it really need, a complete refresh of kitchens in every unit, or can we just put granite countertops? That's a $2,000, $3,000 savings per unit for us, and that makes a big difference in today's world from a price perspective. So I think it's, understanding what the right upgrades are, understanding what the right potential of the deal is, and then just executing from the strategy going forward.
Great. And I want to end with some predictions, and we're going to have to keep these last few questions somewhat a little bit more rapid fire, just because we only have a few minutes left. But Alex and David, will the market for skilled nursing properties remain just as strong in 2023? Why or why not? David, you want to start?
Okay. Yeah. I think it's going to keep on pace. I don't think it's going to increase materially. I think it'll keep on pace. I think that's going to be because there's more legislative Medicaid rates that are passed through, but the frothiness will be offset by federal staffing mandates, if that actually rolls through, or increased state scrutiny.
Awesome. Alex?
And I'm not even going to try to follow it. I agree.
You guys are great at
I love you, Alex. Thanks.
I'll defer to the second half.
And Alex and David, do you have similar thoughts on where prices and cap rates will go? Like not a big change in 2023?
Flat.
Alex?
I actually think you probably flat. I think you might actually start to see senior living cap rates dip a little bit. I think interest rates probably won't, but if you think about the way that a lot of people, it's the forward curve, right? If we get to the point where it feels like interest rates have leveled off and it's only a matter of time before they start to, those people that are 7-10 year holders start updating their model for that. I wouldn't bet that you necessarily see it this year, but I think there's a very good chance that if not shortly thereafter.
If I may, as a touche to that, yield curve. I think the yield curve's gonna, yes, the 10 years gone up to 390 and change, but that perm stuff prices off the 10-year, right? 10-year swaps, I think. So if that yield curve remains inverted, then as long as you can get to a perm debt solution and stomach that short-term bridge, I think that's going to keep prices good. Talking seniors.
That's a good point. Camilo, continuing with seniors and kind of going beyond Lloyd Jones's strategy or your thoughts on the market, what types of seniors housing properties are going to generate the most interest from buyers in 2023 and why?
It's a good question. That's not a rapid fire question. I think the AL memory care is still probably up there. For us, or just my view, independent living is a tough one to value just given it's not necessarily need-based. And then I think an asset class that you touched on when we opened that's kind of sneaking its way in there is this age restricted, 55 plus world where, I feel like every building I see, it's 95% full and, has a wait list. So I think that's one that's going to be attractive. And I think that's kind of the bridge to get these multifamily investors into, feeling in that senior housing spectrum. If you want to call it, it's, hey, we've done multifamily for the past 15, 20 years. I can't hit the returns, on a multi-deal anymore. So let me try, to explore that avenue. And independent living was too much of a business. So 55 plus is kind of that in between. And then maybe that kind of does the breakthrough for independent living and, AL memory care to follow after that. So I see those asset classes kind of, starting something, I guess, if you want to say.
Yeah, no, I'd agree. Well, I think we have time for one more question, and David, it's going to be directed towards you, but everyone else feel free to jump in quickly afterwards. Are we finally going to see a wave of distressed deals hit the market in 2023?
Not a wave, but maybe a couple of streams. And honestly, all joking aside, it depends on who's the debt holder, right? And how much does the debt holder have out to you? Are they a depository? Are they not a depository? Right? It also depends on who's in the ownership structure. Do you have deep pockets? Can you do follow-on calls? It also depends on those folks that have rescue debt funds, the debt funds raised for rescue capital that you're starting to hear folks talk about in the different CRE food groups. Do they start to deploy rescue capital on a pref or a mezz and pay down, remargin, and extend the existing senior? Stuff like that. So I would suspect no, not a wave of distress deals. I don't think it's going to be the market clears in 1 month and all distress deals at the market, because honestly, those owners don't consider those deals distressed because they're looking at a long-term view and they have the pockets to fund it. Those that don't have the pockets to fund it, well, then we know what's going to happen there, but then there's going to be folks on the other end of the table that hopefully we're financing and they have a good buy. So that's my perspective.
Yeah. Any last thoughts from anyone?
Oh, yeah, one for me. If there's any lenders that were listening to this and went, hey, you unfairly painted us with a broad brush. We're active. We'll do value add. We'll do non-recourse. Would love to talk to you after the call. So if you heard this and hey, what about us? No. Don't call him. If anybody heard that, like, hey, that's not us. Love to talk.
And our panelist emails are in the slides, everyone. So please feel free to reach out.
I'll just get hate email then.
Keep the hate to a
And
minimum.
you're active.
Yes. Yeah. Be nice to David.
He's active.
I'm listening to this. Be nice to him today.
All right, you guys. Well, thank you so much. This, I think we touched on almost all the points that we wanted to today. An hour is tough. Slogging through all the statistics is tough. But if any of our listeners have any follow-up questions with either me or our panelists, please feel free to reach out. Again, our emails are in the slides. And I just want to note that our next webinar is on March 16th, and that's covering the active adult market, where we're going to discuss everything in the emerging sector, who are the buyers, what's the development market like, and also where valuations currently stand. We're going to be launching some of our new proprietary statistics on that sector in that webinar. So please feel free to join us March 16th. And until then, you guys, thank you so much for the conversation. It was very lively, a lot of great answers, and hope you get a lot of calls out of this. But thank you again. I appreciate it.
Thanks, guys.
Thank you.
Absolutely. Take care.
Thanks, everyone.
See ya.
Bye.